you really are not answering the issue of how to deal with retirement income consistently in your retirement.
Next up, it's Peter from Bryant. With recent economic growth, should I be more aggressive with my investments now? Or is this a sign I should be more conservative as I approach retirement? Peter, I'm going to say, first of all, let's not create an investment strategy based on signs. We don't know how old you are, and I think that matters greatly. Your risk tolerance matters greatly, but I would not look at recent economic growth, and I don't know how recent we're talking about, if we're going all the way back to COVID and since then and seeing what the market's done, or just this year, where he's attributing his belief that we're having recent economic growth. That is not in itself a sign to really change anything investment-wise. Your investment strategy should be unique to you. And if we're looking at signs, if we're looking to read the tea leaves in some way, and even if we're doing that from a very fundamental way and look at what economists are saying, I like to point out that we can't ever assume that things are as good or as bad as they may seem. Because from 2021 to 2023, what were we seeing? We were seeing high inflation. We were seeing interest rates go up by the Fed. We were seeing a majority of the country's economic minds predicting an imminent recession. And by imminent, meaning tomorrow, right? It's going to happen. Well, here we are at the end of 2024 almost, and that recession has never happened. Now, there's going to be a recession sometime in the future, but if the best minds in the country can't agree or get it wrong, it doesn't make sense to make an investment strategy, Janet, based on where the economy is really at any given time.
Yeah, absolutely. So another thing from your question here, Peter, when you talk about being more conservative as you approach retirement, we don't know how old you are and how far out retirement is for you. And approaching retirement, some people talk about that 20 years out. Some people talk about it 2 months or 2 weeks out. We've had some people come in and tell us, I retired last week, now what? We really prefer to get ahead of it a little bit more than that, but it does happen. So what we would say is important is to, again, think about that timeline. How far away is retirement, and how do you need to begin to adjust those assets relative to an income plan, not relative to what is the economy doing or what are people saying the economy is going to do. Again, very much like we talked about in the question from Gail on our last question, it is way more about solving for your income regardless of what the investments are going to do in any short-term time period.
Yeah, absolutely. And I want to bring back up the bucketing graphic if we can, Casey, because I think this is really easy to build off of the last question. So we're talking about in retirement, this is the way this needs to be set up, and your money needs to be diversified in such a way that the early buckets are conservative, the middle bucket is moderate, the outer buckets are growth. Your timeline to retirement can still fit into this, right?
Yes.
If you are 10 years away from your retirement goal, you don't need the first two conservative buckets. You need to begin to position the moderate bucket, and the rest can continue to be growth. If you're 5 years away from your retirement goal, you're going to need bucket two. You need a bucket position in a moderately conservative investments so that it can waterfall down on your retirement date to that first bucket. So having that knowledge from Peter helps us begin to determine how or if he needs to be diversified in his investment strategy.
Yeah, and I think that the buckets that speak so much to what we were talking about earlier about, whether retirement is a stop sign or a yield sign, and it really is appropriate for you to diversify those assets before you get to the point of retirement, and diversification relative to when those dollars are going to be used, not, Scott, what we, so often hear people talk about still about, I've got diversification, I've got a 60-40 allocation, but if you're planning to take income from that 100% pool of investments as opposed to taking it from the more conservative elements, you really are not answering the issue of how to deal with retirement income consistently in your retirement.
Yeah, and I'll finish up, Peter, with this before we move on to our final question. If you do want to go after some more aggressive investments, if you're into individual stocks, if you want to really take temporary runs or look for temporary runs because the economy's good. Certain sectors might do well for a short period of time. That's fine. Just don't do it with your retirement money. It's fine to have some sideline money to work that, right? But I look at it as your casino fund, right?
Yeah.
You may not lose it all, but you got to be prepared for that, right? You don't want to take chances with your financial independence.
Yeah, we jokingly call it Vegas money, and if you're not a gambler, don't be offended by it. Call it Chuck E. Cheese money. You know,
right.
You're going to go in with a certain amount of money, and you're going to come out with less, and that's okay, and you know that. The same needs to be true on that type of more aggressive approach to investing. You don't gamble with your mortgage payment.
Right.
You don't gamble with your grocery money. That's when it's a problem.